Seshagiri Rao, the Joint MD and Group CFO at JSW Steel, joining in right now to really help us understand the dynamics of the steel industry. Mr. Rao, morning. Good to have you on the show. And first, at the onset, here's wishing you and your entire team at JSW Steel a very happy new year from all of us.
Happy New Year to you and all the viewers and their families.
Thank you so much. Mr. Rao, just wanted to understand the dynamics within the steel industry. Like my colleague was just highlighting right now, you know, where there is, it's a reality that we're going through a tough time with profitability levels falling. Would you attribute this to the steel price fall, or would you say that this is because of the slowdown that the economy in India is currently witnessing?
No, it is both the factors, global and local. If I see steel industry has to be understood what is happening globally, because it is a globally traded commodity. Almost 1/3 of the steel is traded and leaves the borders of the countries. The trade dispute which arose between China and US, that was the starting point, which led to overall slowdown in the global economy that has an impact on the steel industry. Because steel consuming sectors, starting from construction, infrastructure, real estate, manufacturing, auto, we had seen slowdown globally, so that has an impact. In line with what is happening globally, in India, what contributed again for a bigger slowdown relative to what happened in the steel industry globally is the slowdown in the government expenditure and also the credit flow to the industry. Both together had a very serious impact in the overall fall in demand and also fall in prices, and at the same time raw material prices have not fallen in the same proportion. So all this together put pressure on margins. That's why the industry went through a severe pain in the first half of this financial year. Over and above what happened in the industry in India, the FTA countries continue to export steel into India because it is 0% duty. It has gone up from around 58% in the last year. It went up as high as 77%. So that is the kind of range in which the imports are happening into India from FTA countries, either Japan, Korea and Asian countries. That also contributed to the fall in the steel prices in India. As I have been giving the numbers, the fall in steel prices in India is much steeper than what happened globally. So all this put pressure on the steel prices. But what we have seen a bit of recovery starting from October. So this quarter which we ended appears to be better as we are hearing from other steel companies also that they reduced the inventories and their sales were better in the last quarter. And this is the trend we are seeing, which is expected to be better in the third quarter compared to second quarter. And generally second half would be better. That is the expectation which we all have.
Yeah, and that's exactly the chatter that we are picking up as well, that there is finally some uptick coming in steel prices. Could you help us understand, though, that at an average, what is the kind of appreciation that prices have seen?
Prices started going up from November 2019. Otherwise, the domestic prices are at a discount to the landed cost of imports in India. So November, December and January recently we have hiked the prices. So all these three hikes together, if I compare today the landed cost of imports vis-a-vis domestic prices, still domestic prices are at a discount. So that is the trend which we are seeing, but the prices are picking up. That is one positive news considering the some revival in the domestic demand. So price increases have happened in the last 3 months.
Looking at another increase then, Mr. Rao, would you be looking to increase prices as early as Jan, like now?
International prices, if I see $430 used to be the price. Today we are seeing close to $520. That is the kind of increase in the global prices. Rupee depreciation has happened in India. So both together, if we look at it, there is a scope for increase in the domestic prices. But if we compare the peak of the steel prices in India in the last year vis-a-vis the current prices after 3 increases which I just explained, November, December and January, and compare it to the landed cost of imports. So there is a scope for increase in price in the domestic market.
Will the buyers accept this increase in price? Because previously when you tried to increase prices in the month of September and August, there was resistance which was coming really at the buyer level.
Expecting the global prices continue to fall and the domestic prices will follow the similar trend, what we have seen in the first half of the last financial year, the inventories which are lying in the entire channel has been used instead of buying new material. So that has caused more pressure on the producers in reducing the price. That's why no price increase was possible. Now the international prices started going up. In line with that, local prices started increasing. So now everybody come back to the market for restocking. That is also one of the reasons why we are seeing the price increases which we have done is sticking, number one. Number two, auto sector, as you know, we increase the price every half year. So whatever price fall that has happened in the first half of the financial year, it has been renegotiated for the second half. So the prices in the second half to the auto sector is much lower than the current prices which are there in the marketplace. So this is also one of the reasons why the price increase other than auto sector will be better in the second half of this year over last year, because nobody is expecting global prices will fall below these levels. So in line with that, the local prices also will increase.
Industry, Mr. Rao, what we've seen is that we've seen two takeovers because of IBC. You've acquired one large asset, the Tatas have acquired one large asset, which means more than greenfield, existing capacities are the ones which big players have bought into. So do you think for next 2 to 3 years there is enough and more capacity in the country, and large players like JSW Steel, they may not be looking at a very large greenfield expansion, because your utilization levels are low, and on top of that you also acquired assets, so your capacity is fully taken care of?
What we are seeing through IBC is consolidation. So these companies are existing operating companies. The capacity utilizations in these companies are reasonably at higher levels. So even after change of control because of various other reasons through IBC, I don't think a very big capacity or incremental production that would come into the market. Considering the total capacity of the steel industry of 140 million ton, in this year we will be producing 110 million ton. So the capacity utilization is reasonably high in this industry. So if we continue to grow even at a rate of 5% on 100 million ton of steel consumption, so we need every year 5 to 6 million ton of incremental steel demand. For that, I think new investments are to be done, either brownfield or greenfield, to meet the growing demand. So the acquisitions is only change of control. I don't think it will contribute to the capacity or the incremental production in the market.
Significantly increased your capacity in the decade gone by. 2010, your capacity versus where it is right now, you've significantly increased your capacity. And your thesis, I remember when we met in 2010, was that India's steel demand will always grow in line with India's GDP. Now that India's GDP has come below 5%, do you think next 10 years the steel demand, A, largely because of demand in autos where there is a disruption, B, demand in housing where there is a delay, and C, in general, given that globally also trade war is having an impact on demand, there could be a relook at the steel demand?
Steel demand, as far as India is concerned, it will be driven by mostly infrastructure, construction and real estate. So if you see the national infrastructure pipeline which has been announced of 102 lakh crores of rupees, in that the roads, energy and urbanization, these three will contribute almost close to 60% of the total infrastructure built in India. Out of the 60%, if you see, they are mostly steel consuming industries where steel demand it is quite positive for this pipeline of national infrastructure which has been announced. Over and above that, if I really see FY20 versus FY21 numbers of outlay by the government, which is 13.5 lakh crores in the FY20 and the infrastructure, including both central, state and the private sector. That amount in the FY21 number is 19.5 lakh crores, which is 43% more than FY20. That is the kind of outlay on the Indian infrastructure the government of India is planning, all the three segments of constituents together. If that is the kind of infrastructure investment which is going to happen in India, then I think steel is the immediate beneficiary of this infrastructure spend. That's why we are quite positive as regards to the steel demand in India going forward. The 2030, the vision of becoming 300 million ton steel industry for India, I think it is not unrealistic.
Mr. Rao, where do you see the HR price band moving in 2020? What's the kind of band that you anticipate? Currently from that 450 to 500 mark, do you see them going up in a meaningful manner internationally?
No, I think we have to look at when in the past steel prices were in the range of $500 to $520. What were the raw material prices at that time? Either you take scrap price, you take iron ore price, or you take coking coal price. Iron ore prices were significantly higher than what it should be. $65 or 60 to $65 was the price in the past, which has gone up to 120 and came down to 90. So when compared to 65, today iron ore prices are higher by $25 in the market. Every 1 ton of steel you need 1.6, 1.7 times of iron ore. Therefore, today the cost of production to the steel sector, because of iron ore prices being at an elevated level, they're higher by almost close to $40 to $50 per ton. If this is the cost pressure which is there, so the margins for steel companies, even at the current prices, will be under pressure. Therefore, steel prices have an upward bias going forward. Of course, only one qualification is demand. Whether demand continues to be picking up going forward, for that I think the World Steel Association has been guiding for 2020 incremental demand of 1.7%, which is 30 million ton over 2019. This 30 million ton is also contributed 10 million ton approximately by China, and 2/3 is other than China. So the World Steel Association is expecting some revival in the overall demand scenario for certain sectors, particularly the manufacturing, which we have seen the lowest levels in July and August started picking up. So capital goods, engineering, manufacturing, these sectors will contribute for the incremental demand over and above some revival in the construction, real estate and infrastructure sectors. So therefore, there will be some revival in the demand other than China. Considering that, I feel the steel price has an upward bias in the year 2020 over $500, $520, what we are seeing right now.
A heavy capex outlay, plus there are acquisitions as well, which also I'm going to just talk about in a short while. How is it that you're going to manage your cash flows, your debt positions, etc.? I'm sure at the back end you've got a strategic plan, lined up.
I think the brownfield expansions, whatever we have been doing, we are very, very cautious in doing that. And also the positioning of those expansions. So now when the demand for steel in India is expected to look up from here on, I think JSW Steel is the only company which has been bringing in new capacity of 5 million ton in the next financial year. So we will have a 5 million ton coming up from JSW Steel fold in FY 2021. And at the same time, we are also expanding our downstream capacity by 4 million ton. This downstream capacity is highly value-added products. So these two together, I think it is very well timed in terms of our brownfield expansions which we are doing. So this 18 million ton will go to 23 million ton. I don't think we need to worry about our financial ratios, because we have kept them in mind of 3.75 debt to EBITDA and 1.75 debt to equity, considering that we have been calibrating our capex program. Then as regards to the the acquisitions which we have done, inorganic growth, if you see the past, whenever we have acquired any company which is under financial stress, we position that company or we have placed that company in an SPV until turnaround happens. After turnaround is done, within 2 to 3 years' time, we have merged into JSW Steel. So that is the model which we have followed. Thereby, balance sheet of JSW Steel is not stretched or is not stressed. That is what we have done in the case of Siscol, what we have done in the case of Ispat Industries, which we did in the year 2010. So after the IBC came into place in 2016, we did one acquisition of Monet Ispat. It is exactly a similar structure we followed. So we are in the process of turning around this company. In the 2 to 3 years' time, we will turn around this company from the date of acquisition. Same story in the case of Bhushan Power and Steel. Even though JSW Steel is the sole bidder, I mean in its own name it has submitted its bid. Our idea is to follow a similar pattern as we have done in the case of Monet. So we will place this company in an SPV until turnaround happens. Thereafter, we will merge into JSW Steel. So that is how we are planning our inorganic growth story. So we are very cautious about the overall financial profile of the company.
Some of the other IBC assets that you could potentially be interested in looking at, anything else that could possibly be on your radar?
There are not much bigger assets that are available beyond 1 million ton. If at all, there are very smaller assets. But we have some interest in the downstream. So we are one of the preferred bidders in the case of Asian Color. So that as and when the approval comes from NCLT, we will complete that. I think that is only the company where we are right now in the steel space.
Mr. Rao, just closing comments. In between 2000 and 2010, if Indian companies were expanding and if they were increasing their debt to equity ratio, markets were rewarding it because that was considered as growth debt. Suddenly, in the last 10 years, every time companies have expanded and debt has gone higher, markets have punished those stocks. It has forced most of the corporate companies to start reducing their debt. Tata Steel is looking at reducing their debt. Reliance, they've said that we want to become a net cash company. Consciously, are you comfortable with these debt levels, or you also could think at reducing your debt levels dramatically?
We always look at relative ratios. We don't look at the absolute amount of debt. So when the company is 18 million ton, we can't say we'll reduce our debt to the level of 2002. That is not workable. So we have kept the ratio of 3.75. We are comfortable with 3.75 for a company which has grown from 1.6 million ton in the year 2002 to 18 million ton today, and in the next 1.5 to 2 years time, we will be close to 28 million ton, including the acquisitions which through IBC which we are doing. So if that is the kind of growth, this 3.75 and 1.75, we are quite comfortable in those ratios.
A 50 million ton company.
$18 million right now.
No. You said you'll become 28 million after the acquisition in the next 3 years. My question to you is that when in next 10 years, when will you become a 50 million ton company? Will it be 2024, 2025? It's a very aspirational number, but I'm curious.
We are 15 to 16% of the today's installed capacity is our capacity. So we would like, even if we assume that we maintain that kind of market share in the overall installed capacity, if 300 million ton is the India's capacity by 2030, so we will be in the range of 45 to 50 million ton by 2030. Considering the pace of growth in India, if this 300 million ton is expected to be achieved even earlier than 2030, we also grow in the same pace. So we wanted to be 45-50 million ton player in the 300 million ton total play in the steel industry in India in the next decade.
I was specifically looking for that answer, which is that you have 15-16% market share and you are likely to increase it or consolidate that. Wonderful to have you. We've started with your short-term outlook on steel prices, and we've got a vision statement for next 10 years. So have a great year and a great decade ahead. Always a pleasure interacting with you.
Thank you. Thank you very much.